Lesson 7, Fundamental Correlation, and we're looking at the PPI economic indicator. Now, fundamental correlation is simply using one indicator to help us identify the possible outcome of another economic indicator. So, if we know, for example, that the PPI and the CPI are directly correlated, then we simply use the one that comes out first to help us to predict the outcome of the one that comes out second. So in this case, PPI comes out before the CPI. Now, PPI is Producer's Price Index and CPI refers to Consumer's Price Index. Now, these two indicators are extremely correlated, and as a result, a high PPI will affect market sentiments towards an higher CPI release. So a lot of traders are just waiting on the PPI to trade the CPI. What a lot of traders will do is they wait on this PPI release, and based on the PPI release, they will trade the CPI and not fundamental announcement. So if they get a better than expected PPI release, then they are going to trade expecting a better than expected CPI release. Also, if they get a worse than expected PPI release, they're going to trade expecting a worse than expected CPI release. So a lot of traders trade this way. So high PPI normally affect market sentiments towards a higher CPI. Now, PPI relates to the cost producers pay to manufacture goods and services, while the CPI relates to how much these goods and services cost consumers. Here you can see the direct correlation that PPI and CPI has, because if a producer is paying more to produce his goods and services, he's going to in turn charge consumers more for those goods and services. So there you can see the direct correlation between PPI and CPI. Now, as I said before, PPI data is usually released before the CPI. So we can use the PPI to give us an idea of what to expect for the CPI. And a lot of traders trade in this way. They wait for the PPI to trade the CPI. So in the next lecture, we'll be looking at fundamental correlation, and this time we'll be focusing on retail sales.